Hi everyone, I'm Oasis, an assistant coach from JLaw team. Whenever a trader takes a trade, the goal is always the same: I want to make money. But the truth is, only a few can stay consistently profitable in the market. What sets them apart? I asked myself that question for a long time, and I didn't find the answer until I started learning trading from JLaw, the two-time US Investing Championship winner. That's when I realized something important. The biggest difference between winning traders and losing traders is the mindset. Losing traders jump into the market simply because they want to win. Winning traders enter the market only when they know how to win. More specifically, winning traders understand exactly where the edges lie every time they place a trade. After 16 years of trading, reading countless books, navigating different market cycles, and testing hundreds of indicators, JLaw finally built a clear framework for identifying the edges that truly matter and combining them to make high probability trades. This framework became the foundation of his core trading approach. It helped him achieve the multiple years of triple digital returns and win the US Investing Championship twice. He called it the multiple edge trading strategy. And today, through this series, Oasis, JLaw's assistant coach, together with Z, my assistant coach, will guide you step by step to learn the multiple edge trading strategy. Our goal is to make everything simple, clear, and practical so you can understand it easily and apply it to your own trading right away. Are you ready? Let's begin. Allow me to start the first lesson with one simple but important question. Have you ever actually paid attention to what's going through your mind when you hit the buy button and enter a trade? If you have been losing money for a while, that is something worth thinking about. Because when you pause and look back at the moment, you started to see the patterns behind the trading decisions, including the hidden bugs in your logic. And once you realize those bugs are there, you finally have a chance to fix them. If you don't, then no matter how many indicators you study, how many courses you take, you keep running into the same losses again and again. Because real improvement does not come from repeating the wrong. It comes from correcting the wrong, then repeating the right. So next, let's look at how typical retail traders, especially those who keep losing money, make decisions. Let's take Tesla as an example. Go back to the end of 2021. Tesla stock had been climbing for several months. Then in December, it surged from 300 to 400 in one single month. The trend looked unstoppable. Afraid of missing out, people rushed to buy. And after entering the trade, they did everything they could to justify their decisions. They searched for every piece of good news they could find, positive headlines about Tesla's growth, optimistic analyst comments, even bullish calls from the investment banks. Their confidence grew, hope filled the mind. They start dreaming, this trade will make me rich. Soon I can buy a big house and new car. But reality hit. Right off the boat, the stock began to fall. Then people comfort themselves, saying, it's fine, I'm not a trader, I'm a long-term investor. They refused to cut their losses. Their account kept bleeding for 2 months, until one day a big red candle appeared and Tesla dropped 10% in one single day. Panic set in. People couldn't wait to cut their losses, and the moment they sold, the pressure disappeared, and they swear that they would never check the stock again. But a few weeks later, curiosity called them back. And what did they see? Since the day they sold, Tesla had been climbing non-stop. They felt so frustrated and disappointed. But the painful memory of the previous loss still lingered. So they didn't buy back in. They didn't buy here, here, and here. Until one day, another big green candle appeared. And once again, the fear of missing out took control. They completely forgot the pain of their loss. They couldn't wait anymore and jumped back into the market. And then history repeated itself. They did everything they could to justify their decision. They searched for good news, positive company updates, bullish reports, and promising forecasts from the big banks. They dreamed of making money from this trade, buying a big house and a new car. But only a few days later, the stock started falling again. Look at the chart. They were desperate and shouted at the sky, "Are you kidding me? This is not fair. who is actually making money in this market? Does this thing feel familiar? Are you one of them? The truth is, many people trade exactly like this. Instead of calling them traders, you would better call them gamblers. Because when they enter a trade, they have no technical foundation, no real edge, no logical reason. They're driven purely by emotion, convincing themselves they would win. But here's reality. No one has a crystal ball, and the stock market offers no guarantees. Most people's expectations never come true, so they end up losing money. After being hot hit by the market, someone give up, and others insist. They change themselves. They start studying technical analysis. But after learning just a few indicators, they think they figured it all out, and the new knowledge is enough to help them win. For example, some people trade based on the 50-day or 200-day moving average. They learned that those lines showed average stock price over the past 50 or 200 trading days, and they can act like support or resistance level, basically good areas to enter trade. Take Amazon as example. From late 2024 through February 2025, the stock had been trending up, and a lot of traders missed the earlier chance to get in, so they were looking for a good entry. They found that for 5 times, whenever the price pulled back to the 50-day moving average, it bounced right of it. Then those traders assumed that the 50-day moving average would be solely the support. So when the price pulled back to it again, they jumped in. But what happened next? The price dropped. This is another example. For years, Google was seen as a leader. People believed that buying Google on dips was always safe. Google stock had been holding above the 200-day moving average for a long time. And the last 2 times it touched this line, it bounced right of it. So when it touched the 200-day line again, they bought. But right after that, the stock started to drop. The price kept crossing above and below the 200-day moving average, which showed that this M.E.T.A is not always a reliable support line. Some traders don't use moving average. They rely on candlestick patterns. In candlestick trading, when the price breaks above the previous high, it's usually a signal to go long. Why? Because the stock's price is the outcome of buyers and sellers battling it out, and the previous high represents the strongest push buyers managed it last time. So if the price breaks above that level again, it's market saying, hey, buyers are stronger now, and the trend might continue higher. Let's take a look at IREN as example. In just 2 months, IREN ran from 25 to 75. Clear evidence that buyers were in control. But once the price hit 75, sellers pushed back, and the market formed the belief the price probably won't break above 75. But soon buyers stepped in again, and this time even stronger. They drove the price straight through 75 without hesitation. So what does this pattern tell us? It told us that this old belief, 75 is the top, had just been invalidated, and the price might keep moving higher. Naturally, a bunch of traders bought right at the breakout. But what happened? The price started dropping. All of those traders use some form of technical analysis, but why did they still fail? Here's the key point. Those traders fail so easily because they enter the market based on just one single indicator. But in real market conditions, no single technical indicator is consistently reliable. If you trade based on just one signal, the success rate is really low. Many indicators work only 20 to 30% of the time, and during some high volatility market environment, their accuracy can drop to under 10%. So here's the real question. If relying on only one indicator makes it so easy to fail, why not build an entry strategy that is supported by multiple technical reasons and several advantages? Think of it like dating. If you believe you can win over your dream girl just because you're handsome, come on, that's just wishful thinking. Being handsome and funny at the same time might raise your chance a little bit. If you also have a promising career, she might say yes to dinner. If you show her that you're reliable, she might be willing to spend more time with you. But if you got all that, plus success, maturity, loyalty, and kindness, well, at the point, she doesn't just want a date, she wants a wedding. You can think of trading the same way. There are many types of traders in the market. institutional investors, high-frequency traders, professional traders, algorithmic traders, retail traders, and more. And different traders use different indicators. Some focus on candlesticks, some using moving averages, others rely on trend lines or parallel channels. And now imagine this. On the chart, there's a price range that is supported by all those indicators at the same time. What will happen? Let's use CRS as an example. Some people trade on previous high, some trade on moving averages, some trade on the trend line. But if you combine the three factors together, what will you get? And you can find on May 12, some buyers try to break above the previous high. Then sellers step in and push it back down. But soon the 10 MA and uptrend line support the price immediately. That shows one thing. Traders using different indicators were all defending the same price zone. A market consensus formed and most people agree, yeah, the price should hold here. So the support got even stronger at the level and the buying pressure accumulated. So if you go long here, the old price moving higher shot up, and afterwards, the stock kept climbing non-stop. Shorting works the same way. Take Tesla for example. Here, the price was held down by the previous low, pressed by multiple moving averages, and capped by a descending trend line at all once. That's kind of an area where most traders were thinking, yeah, this is where I should sell. So if you enter a short position here, the chances of the price continuing to drop are pretty high. And as it turned out, the stock did fall afterwards. The price zone where multiple indicators confirm each other, where several signals line up and reinforce each other, is what JLaw called the multiple edge trading area. And if you enter a trade around the multiple edge trading area, the approach you use is the multiple edge trading strategy. We use multiple edge trading strategy because we don't want to take trades that are supported only by a small group of retail traders. We want to enter at levels where collective strength of the market aligns, where most participants are all in agreement. We use multiple edge trading strategy because we don't want to take a trade just for one reason. We want to trade on multiple confluences, all pointing in the same direction. And that alignment, that consistency is what truly boosts the probability of success. Multiple edge trading areas don't appear so often, and they are not always easy to find. But that's exactly why trading in these areas comes with many benefits. The first benefit, it lowers your trading frequency and helps you avoid unnecessary trades. The longer you stay in the market, the more you will realize that most of your trades are simply a waste of time and money. Big profits come from a few high-quality decisions. And when you act only at the most favorable moments, you avoid overtrading, and you stop trading just for the sake of trading. And over time, it will improve your success rate and become more focused and disciplined. And second, M.E.T.S can provide you with a better risk-reward ratio. When entering a trade inside the multiple edge trading area, if you're correct, profits tend to come quickly. And if you're wrong, the M.E.T.A provides clear technical guidance to help you define your stop loss easily. Typically, you can place it just below the M.E.T.A. If the price breaks below, you exit immediately. The third benefit is that M.E.T.A works not only in the stock market, but also in all financial markets where chart-based trading applies. And finally, M.E.T.A cuts through the noises. You don't have to chase headlines. You don't have to react to the news. Just focus on the chart, find M.E.T.A, and trade based on clear signals. Now, you may be wondering, which indicators can be considered as real edges? JLaw has identified 9 categories of edges. If you're not familiar with these terms yet, don't worry. In the upcoming videos, Oasis and Z will walk you through each edge step by step and show you exactly how to apply them in trading. So remember to subscribe to this channel and turn on notifications, then you will be the first to know when we release the new videos. Before we break down each of the 9 edges, it is essential to understand 4 general principles for using the M.E.T system. These principles serve as the guiding philosophy behind all edges and to provide you with a clear direction for applying the system effectively. First, learning multiple edge trading strategy is just the first step towards consistent profitability. The M.E.T. system is a strategy for entering the market. To actually achieve long-term and stable profits, you must also learn how to exit properly, size your position, control your losses, manage your mindset, and more. Trading is a brutal and tough game, and one small mistake can cost you real money. In this market, doing things 99% right is still not enough. If you want to be the winner, you need to execute every step with 100% precision and operate at a professional level. That's exactly why investment champion JLaw officially launched the JLawStock Academy. The goal is simple: to develop traders and investors with true professional capability. JLawStock Academy is a continuously evolving, up-to-date trading program led and supported by JLaw coaching team. No matter where you are starting from, the program provides a clear structure path from the fundamentals to professional level skills and execution. And throughout the journey, the team is there to guide and support you every step of the way. If you're ready to level up, click the link in the description and take the step from participant to professional. Second, the 9 edges in the system are not all equally important. Some work in most market conditions, while others only matter in very specific situations. You need to know the difference, otherwise you cannot use the system correctly. In the upcoming videos, we will show you which ones matter most and which ones are more situational. Third, when we talk about multiple edges, we really mean multiple. You should only consider entering a trade when at least 2 or 3 edges show up at the same time. There's no perfect strategy. If you wait for 5 or 6 edges to line up, you will get fewer trading opportunities, but your win rate will be higher. If you enter with only 2 or 3 edges, you'll find more opportunities, but you will take on more risks. A professional traders know how to balance win rate and opportunity, and they know when 2 or 3 edges are enough and when the market calls for more confirmation. And that's exactly what you will learn in our future courses. Last but not least, M.E.T. system points the way, but you decide how to walk it. Look, JLaw don't build the M.E.T. system to give you a perfect, fixed, one-size-fits-all trading formula. He built it to give you a framework, something you can keep leveling up as you level up. As your skills grow and you gain more real market experience, you will start discovering your own edges. You will realize that what JLaw teaches is just the foundation, and you can build your own version of the M.E.T. system on top of it. JLaw's M.E.T. system has 9 edges. Your version might have 14, 15, or even 20. As long as it helps you win consistent profits, that's totally fine. Who knows, maybe one day your strategy will even outperform JLaw's system. And that's exactly what JLaw wants. He always says, great teacher don't create followers. They raise students who grow beyond the masters. So, the question is, are you going to be that student?